What if I told you there's an investment strategy that can provide real estate-like returns without ever dealing with tenants, toilets, or trash? Welcome to the Alternative Investing Doctor podcast. I'm Dr. Keith Grosshans, a practicing neurologist who's been exploring alternative investment strategies. In today's episode, I'll explain what mortgage notes are, why they're worth considering as a physician, and how they would compare to investments you're already familiar with. Let's start with the basics. What exactly is a mortgage note? When someone buys a home with financing, they sign two critical documents. First, there's a promissory note. This is the promise to repay the loan under specific terms. Second, there will be either a mortgage or a deed of trust. This actually secures the promise to pay against the property. As a note investor, you're essentially buying these documents. This allows you to become the bank rather than be a landlord. And instead of owning the physical property, you own the debt that is secured by that property. Here's a simple example. Say John borrowed $200,000 to buy his home. After making payments for 10 years, he still owes the bank $150,000. The bank might decide that they will sell this note off to an investor, and this will often be at a discount from the remaining note balance. As the new note owner, you now receive the monthly principal and interest payments, and the security of having the loan backed by real property. This is a fundamental shift where you move from the landlord to the lender, and this eliminates a lot of the traditional headaches of real estate investing. There are two main categories of mortgage notes that an investor can purchase. There are performing notes and non-performing notes. Performing notes are those where the borrower is making all of their payments on time and as agreed. Non-performing notes, this is a situation where the borrower has fallen behind and has become delinquent. There are also positions that the mortgage can be in. There can be first lien mortgages, which has the priority claim on the property in case of a default, or second lien positions, or even third and sometimes beyond positions, are subordinate to the higher position or first position lien. They will get paid after that first lien gets paid. Now, let's compare mortgage notes with some other strategies of investment that you're probably familiar with. First, let's start with traditional real estate versus mortgage notes. In traditional real estate, you own the physical property, and that comes with maintenance responsibilities, property management needs. You need to interact with and find tenants to live in your property, and it can be limited by your range of geographic knowledge or local area. On the other hand, with mortgage notes, you own the debt that is secured by the property. You don't have to deal with any maintenance costs. And instead of property management, you typically deal with a servicer. For a nominal fee, they will deal with collecting the payments and the accounting and borrower communications. You also do not typically have direct borrower interaction. This is something else that is handled by the servicer. And there's very few geographic restrictions. You can invest in notes from almost anywhere. So now let's consider notes versus stocks and bonds. So with stocks and bonds, your returns are dependent upon the market, and that does carry the potential for high volatility. However, they are very liquid, and this is a benefit of these types of assets. It is easy to trade in and out of them. Now let's contrast that with mortgage notes. So the returns are based off of the terms of the contract, and this is going to carry lower volatility and lower correlation to the markets. And you do have the security of being backed by physical real estate. However, as one of the downsides here, these are less liquid and longer term investments, so you can't easily trade in and out of them. It's more similar actually to the real estate hard assets that we talked about previously. Now let's look at the economics of investing in notes. For context, a typical performing first position note might look something like the following. You may find a purchase price of $65,000 for a note that has an unpaid principal balance or remaining balance of $78,000. The note has an interest rate of 8.5% with 18 years of payments remaining. The monthly payment on this note is $706 for the principal and interest payments. At the purchase price of $65,000, this would net you a yield of about 11.3%. Now, this yield would be before any potential expenses such as servicing fees, which you might pay, which typically can range from $20 to $35 per month, and also does not take into account any potential tax liability you may have on these payments. So then what makes note investing worth considering for physicians? For one, the due diligence process required to invest in mortgage notes leverages the same systematic frameworks that we use in medicine all the time. Systematic data collection and analysis, risk stratification, and evidence-based decision-making. The 7-point note deal analysis framework, which we'll explore in a future episode, applies clinical thinking to investment evaluation. Second, mortgage notes provide portfolio diversification. We face unique vulnerabilities, including shifting compensation models, healthcare system consolidation, and reimbursement changes. Notes can provide income that's uncorrelated with these factors, which can create strong financial resilience when our clinical compensation is in flux or structures might be changing. There's also time efficiency with mortgage notes. So performing notes require minimal ongoing time commitment once they are set up with a servicer. The initial learning curve is quite front-loaded, but the ongoing management can be as little as 1 to 2 hours monthly, although potentially even less depending on how many notes you have in your portfolio. And this is valuable for physicians with demanding clinical schedules. And finally, note investing offers decision-making authority that's increasingly rare in corporate medicine. You get to determine your investment criteria, your risk tolerance, and your management strategies, giving you a lot of control and autonomy with these investments. So now let's consider some of the practical considerations for mortgage note investing. Let's start with capital requirements. Entry-level note investments will typically start somewhere in the $30,000 to $50,000 range for a note that is secured by a single-family home. However, these are typically going to either be notes that are nearer to their maturity, meaning they don't have that many payments left to be that low of a balance, or they're going to be lower quality assets to be this low of a balance. Right now in the market, notes that are on higher quality assets are often going to be in the $100,000 plus range. Now, this could cause some difficulties with acquiring your first asset if you do not have that much money available for the first investment, but there are alternatives to get started with in this asset class that have lower initial capital requirements. The first option would be fractional note investments through note funds. Second, you could form a group and partner with others to actually invest in the notes, thereby lowering your individual capital requirement. Alternatively, you could start by buying partial notes from other investors, meaning you buy a specific number of payments that is less than the entirety of the note, or you could potentially loan money to an investor. In this situation, you would be able to still receive reliable monthly income, and your security, instead of being the hard property itself, would actually be the underlying note that you are lending against. Aside from capital, it's also important to consider the time investment reality. Note investing does require specific education and the ability to perform due diligence. For an initial learning phase, probably at least 30 to 40 hours spread over time would be the initial investment required to actually start to understand and feel comfortable with the asset class. Deal analysis can take anywhere from 30 to 60 minutes when evaluating potential investments. And then ongoing management could require about 1 to 2 hours per month to manage your portfolio when established with servicers. Most of this time can be scheduled around clinical responsibilities, whether on evenings or weekends. It's also important to consider essential partners in this process. There will be the note servicers that will handle the payment processing and the borrower interaction, so you'll want to get comfortable or familiar with good vendors for these processes. And then legal counsel, familiar with real estate law. There are a lot of legal complexities surrounding mortgage note investing, so particularly if you look and plan to be active purchasing your own full notes, it's critical to have a good legal advisor and the states where you're going to be operating, who can provide you advice and help ensure that you do not get yourself into difficult situations. And then finally, you'll want to get comfortable with due diligence service providers for property evaluation. This can be providers for things like broker price opinions, so you know the true value of the properties you're investing in, and title companies that can help you identify any issues with the chain of title so that you do not get yourself into, again, a difficult situation with purchasing an asset that has problems. And then finally, there are tax considerations. Notes have specific tax characteristics. One of their downsides is that they are taxed as interest income, which is considered ordinary income, which is typically going to be taxed at your highest marginal tax bracket. This can get further complicated when you're buying a mortgage note at a discount, as it has different tax treatment than the amortization of the actual unpaid principal balance that the borrower is paying. One way to mitigate some of these tax complexities is to actually purchase mortgage notes in self-directed retirement accounts. They can legally hold notes and they have tax advantages where you can be sheltered from some of the accounting complexities that I just mentioned. We will certainly dive into self-directed retirement accounts and some of their benefits and ins and outs in future episodes. And of course, like any investment, mortgage notes come with risks that should be understood. There is risk that the borrower may stop paying and go into default. While the note is secured by real property, the recovery process can vary state to state. So some of your options for dealing with borrower default might be to modify the terms of the loan, undergo foreclosure proceedings, or potentially get the deed in what's called a deed in lieu of foreclosure, where the borrower can actually sign the deed of the property back to you. It's critical to understand these specific exit strategies and their timelines for proper risk assessment. It's also important to realize that individual states have different laws surrounding these processes. Another risk is the underlying property risk. So this is your collateral, and the value is very important. If there is market downturns, this can affect how much you might be able to recover in a default scenario, and it might also affect how motivated the borrower is to pay. For example, right now, a lot of houses have a lot of equity, and borrowers have a lot to lose if they were to go to foreclosure. In this case, they typically are much more motivated to try to work something out than, say, in 2008 when a lot of mortgages were underwater and people had very little incentive to try to make a deal and stay in those properties. And as previously mentioned, there is legal complexity involved in mortgage note investing, so you do need to get familiar with state-specific foreclosure laws, and then also a lot of the protection regulations associated with the Dodd-Frank Act and the SAFE Act, all these things that came after the 2008 financial crisis, and then also really learning documentation standards related to the mortgage note industry. And finally, I've mentioned it earlier in the episode, but also keep in mind that notes are not a liquid asset. So secondary markets do exist for selling notes, but to get out of a note quickly, you may have to accept a steeper discount than you're willing to do. And this is important to keep in mind, especially if you think you might need to liquidate sometime during the holding period of the asset. If that's the case, this might not be the best strategy to consider at that time. These are typically best suited for longer term investment. So then I think it's important to consider if this is the right fit and is it worth exploring. So consider these questions. Does your portfolio need diversification beyond stocks and direct real estate? Do you have capital that doesn't require immediate liquidity? Would you benefit from building income sources not directly tied to your clinical hours? And are you willing to invest time upfront to learn a new asset class? If you're intrigued by what you've heard about mortgage note investing, here are some practical next steps. First, go ahead and download the free Physician's 7-Point Note Deal Analysis Framework. This is available at alternativeinvesting.com/framework. This includes a systematic approach to evaluating investments that can allow you to do initial due diligence in about 30 minutes. And it highlights key features and pitfalls to consider whenever you're doing this process. Second, Please subscribe to the podcast for upcoming episodes where we will continue to dive deeper into the ins and outs of mortgage note investing. And third, begin your education with some of the recommended resources that I'll have linked for you in the show notes. I hope this introduction has given you a clearer picture of mortgage note investing and why it might be worth exploring as part of a diversified investment strategy. In our next episode, we'll dive deeper into the 7-point note deal analysis framework, which is a systematic approach that leverages the clinical reasoning skills you already possess. This has been Dr. Keith Grosshans with the Alternative Investing Doctor podcast. Thanks for listening.